gold this year because I thought we were going to see recession, which is usually good for gold, and more rate cuts, which is usually good for gold, and high inflation, which should be good for gold. All these factors were good for gold. All those factors are just now starting to come into play. Really, since last July, August, when the labor market's starting to crack, that's when my thesis for this year started to play. But at that point, we're already at 2,500. And now that we're seeing them, I think, pick up speed. I think my outlook is actually more supported by the evidence now than it was last summer. But we're going into that at 2,700. We're looking at a bullish setup for gold and silver from much higher prices.
As we approach the final quarter of 2024, the international gold price has continued its upward trajectory, achieving new highs over the past 8 months. Central banks remain significant net buyers of physical gold, underscoring its status as a vital component of global monetary reserves. According to the World Gold Council's latest Gold Demand Trends report, central banks and official sector institutions have added a net 694 tons of gold to their reserves during the first 3 quarters of the year. This includes 305 tons in Q1, 203 in Q2, and 186 in Q3. Notably, central banks from non-G7 nations such as China and Russia continue to acquire gold even as prices rise, indicating a strong belief in its long-term value as a hedge against global financial instability. Simultaneously, Western investors, previously more cautious, are increasingly turning to gold-backed exchange-traded funds, ETFs, driving further investment into the sector. Renowned analyst Lobo Tiggre emphasizes that the growing participation of traditional and new investors strengthens the case for a bullish outlook on gold. While gold has seen impressive gains, Lobo Tiggre notes that market volatility and price corrections are natural in any bull market. For example, a decline from $2,800 to $2,500 per ounce might concern some investors, but such pullbacks can represent healthy adjustments within a long-term upward trend. Given gold's historical role as a hedge against inflation, and with inflationary pressures continuing, its value is expected to rise. For long-term investors, corrections can provide a buying opportunity at lower prices, positioning them for future gains. Tiggre emphasizes that short-term retracements should be viewed as a chance to buy, reinforcing gold's role as a reliable asset for wealth preservation. For long-term investors, a price correction could present an attractive opportunity to buy at a lower price, positioning them for future gains as gold's upward trajectory continues. Tiggre emphasizes that short-term retracements should be viewed as a chance to buy, reinforcing gold's role as a reliable asset for wealth preservation. We present the clips of Lobo Tigre's insights from his recent interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates.
Gold rolling over, and it's so funny and human and typical that gold bugs, they're only happy if gold's going up.
Of course.
Next all-time high, even if it's just a nominal one, oh yeah, everything's great. Oh, gold is corrected to 2,700. Whatever shall we do? Are you kidding me? 27. I mean, a year ago it was like $1,000 less, a little bit more than that. But if gold cratered right from 2,800 to $300 down to say 2,500, if gold retreated $300, that would be huge. That would whack the gold stocks in a big way. It would change people's decision making in a way that what we've seen so far and the fluctuations so far haven't really done. But 2,500 would be a fantastic gold price for all but the most incompetent gold miners. The setup here is one where you could see a perfectly healthy bull market have a perfectly normal and even healthy correction that doesn't change the overall story or trajectory at all, but creates a spectacular buying opportunity. This is not a prediction. I'm not saying that this is what's going to happen. Gold tends to lead inflation. And as we've just been discussing, the Trump agenda is highly inflationary. I'm not surprised, actually, that we've had some correction and we're holding around 2,700. I'm not saying it can't go lower. I'm saying if it does, I would absolutely see that as a buying opportunity. I would not subscribe to the notion that 2,800 was a peak and the next 5 years is going to be down. I do not think that this year, famous last words, but I do not think that this year is going to be like 2011 all over again. If I did think that, I would have a very different thing to say to you, but I do not. I think if we get a big correction, I would absolutely, I would be as close to going all in as I ever get. I would seize that opportunity with both hands, or all four paws, as the case may be for a Lobo. As for why and what's going on and who and what, the central banks have pulled back. The BRICS or the non-G7 central banks that have been doing the buying, they have cooled off a bit. I think that's a rational response to higher prices, but they haven't stopped. Right? They're still, the net buying continues. So it's not true that central banks have stopped buying. At the same time, it is also true that Western investors are finally joining the parties. And we're seeing that in net inflows to the ETFs. The World Gold Council has reported more institutions and high net worth individuals in the West buying. I don't know where they get that data from, but for what it's worth, they're reporting that that's finally happening. That's very bullish. People have heard you and me talk before, Kai. They may remember that I was bullish on gold this year because I thought we were going to see, recession, which is usually good for gold, and more rate cuts, which is usually good for gold, and high inflation, which should be good for gold. All these factors were good for gold, and all those factors are just now starting to come into play. Really, since last July, August, when the labor market's starting to crack, that's when my thesis for this year started to play. But at that point, we're already at 2,500. And now that we're seeing them, I think, pick up speed. I think my outlook is actually more supported by the evidence now than it was last summer. But we're going into that, at 2,700. So, we're looking at a bullish setup for gold and silver from much higher prices.
The U.S. Federal Reserve has announced another 25 basis points rate cut, following the 50 basis points rate cut announced in December. This follows a period where rising inflation significantly fueled economic discontent, a factor that contributed to Donald Trump's presidential election victory. However, despite the decline in inflation, the economic outlook remains mixed, with solid growth paired with weakening job growth. Additionally, consumer spending remains strong, leading to concerns that further interest rate cuts might overheat the economy and risk reigniting inflation. Lobo Tiggre highlights that while the Federal Reserve has made notable progress in addressing inflation, the battle is far from over. Despite the prevailing narrative that inflation is under control, Tiggre emphasizes that the Fed must remain vigilant, as underlying inflationary pressures still exist. He points out that the Federal Reserve's actions, rather than its rhetoric, will be the true indicator of how much risk they perceive in the economy. While inflation has moderated, the Fed must carefully navigate its next steps, balancing the need to support growth while avoiding any action that could lead to a resurgence of inflation, especially given the current momentum in consumer spending.
The overall narrative of continuing to cut while it looks like we're almost there at the goal and everybody keeps talking about how wonderful the economy is, so why are we doing this? Well, I think that they realize that there's more risk there. And so I think they're addressing that. If they really thought inflation was licked, and if anything, everything was fine, there's no need to change, then, maybe they wouldn't have. But I do think there's concern there. And that's part of what the policy is responding to. It's not what they say, it's what they do. And what they did says, inflation is not licked, but it wasn't a jumbo or anything like that. So they're still concerned. I see this balance there. And sorry, one more thing. You said it's almost at 2, it's 2.1 or whatever. But remember, Powell has long insisted that the PCE, not the CPI, is the main number they look at, and the so-called core PCE is what they're really targeting. And I'm not sure, what the official mandate may be. I mean, it's not actually written in the law what their target metric should be. I mean, the law doesn't say the Fed shall meet X percent of CPI, X to be defined by Congress or something like that. That's not what it says. They have this dual mandate, full employment and stable prices. It doesn't say CPI, PCE, or whatever number you want to invent in there. So it's up to them to decide what their goalpost is. And the goalpost they've made the most noise about is core PCE, which is not coming down. It's stuck just under 3%. It's gone flat for the last 3 prints. 2.7. Okay, it was 2.65, whatever this time. But basically, it's going sideways for month after month. So if I'm the Fed, I'm looking at the number that I've said is the most important, and it's sticky. Then no, I can't say, oh, job done. Let's stop cutting. We're at the, what do they call it? R star. We're right now. We're sufficiently. It's Goldilocks. It's not too hot, not too cold. It's just right.
Doesn't feel like it. I have to admit,
Doesn't
Goldilocks.
feel like
maybe we're in that the eye of the hurricane. How about that? It feels like the eye of the hurricane.
No, that brings back shades of Doug Casey. But again, I mean, just think about it. They have said this is their target. Okay, his lips moving, maybe he's lying. I don't know, but this is, for whatever it's worth, what they've said, and it's still, what is it, 40% above target? That's significant.
As the U.S. Federal Reserve may adjust its strategy in the coming years, there is concern that this could significantly increase inflation, potentially destabilizing the U.S. economy. The effects could be far-reaching if the dollar weakens, especially in 2025. On one hand, a weaker dollar could make U.S. exports cheaper and more competitive on the global market, benefiting American exporters. However, it would also make imports more expensive, driving up the cost of goods in certain sectors reliant on foreign products. This could trigger inflationary pressures and higher long-term interest rates, increasing borrowing costs and putting a strain on consumers. In this scenario, the U.S. economy could experience broader instability, with the dollar's decline affecting both domestic markets and its global standing. During such turbulent times, gold will likely emerge as a safe haven, attracting investors seeking to protect their wealth against inflation and economic uncertainty. Please share your thoughts on Lobo's analysis in the comments below. Also, ensure you like this video, subscribe to the channel, and turn on post notifications for more videos like this. Thanks for watching.